Suppose now that instead of just looking at one stock, you want to think about a portfolio. And remember that a portfolio is defined by the various weights that indicate how much of your funds you've allocated to each stock. So recall that for an individual stock, I, its return on any particular day is beta I times return on the market for that day plus alpha sub I for that particular day. So to compute the return for the entire portfolio, we compute this return for each individual stock, multiply it by the weight for that stock, and then we take the sum across all the stocks. And that's what we get for the entire portfolio. Now, if you note, we can calculate beta for the entire portfolio simply by doing this. Beta for the overall portfolio is simply a weighted sum of the individual betas for each of the stocks. So the capital assets pricing model tells us that we can simplify the expected overall return for a portfolio by computing a beta for that portfolio, multiplying it by the return on the market, and then there's some alpha. So that alpha is composed of multiple examples of this alpha, but remember, capital asset pricing model says that all of these are on average going to be 0, so we don't need to bother necessarily adding them up. We can just approximate it by an overall portfolio alpha. So again, this is what the CAPM tells us we can expect on any particular day, and again, CAPM asserts that this alpha is random with mean 0. The active portfolio manager will say, okay, yes, I agree that the beta component is the same as capital asset pricing model says, but I think I can find value in this alpha and it needs to be broken out individually. So the active portfolio manager is going to have this formulation of what they could expect in return each day compared to the CAPM, which is a little bit simpler.